US stock and bond investors start the week nervously ahead of big tariff news they've yet to fully price in. Gold hits a new record high. Inflation in Tokyo is picking up, which is expected to force another Bank of Japan rate hike. And New Zealand consumer confidence fell in March. That's coming up in our 5 Things in 5 Minutes on Monday, March the 31st. And then in today's bonus deep dive interview, ANZ's head of G3 Economics, Brian Martin, looks at who might be the winners and the losers in the tariffs Donald Trump is set to confirm, or at least announce, on Wednesday night.
The tariff impact is now beginning to show up in weaker plans for consumers to buy cars, for consumers to buy homes or move home. And that could have a material impact on the economy.
But first, in 5 and 5 with ANZ, financial markets and the global economy are on tenterhooks for Donald Trump's big tariff announcements, starting with the release of a big review report tomorrow. Then more details on reciprocal tariffs and sector-specific tariffs on Wednesday night. ANZ Group Chief Economist Richard Yetzinger says investors and traders face almost complete uncertainty.
There have been a couple of press stories supportive of the idea this is going to be a bit, or much less than shock and awe, something which is a bit more considered and a bit partial. Obviously, I'm hopeful that is right, and everybody should be hopeful that is right, but we can't rule anything out. And I think one thing we know about the president is it's not over until it's announced. And even then, of course, it's still up for debate. So markets will be on tenterhooks about this, and there's nothing really we can do, I think, to reduce the uncertainty.
As of 4 a.m. Sydney Melbourne time, the US dollar index was down 0.3%. The Aussie dollar down 0.2% at 62.87 US cents. The Kiwi was lower 0.5% at 57.13 US cents. This was after US stocks fell and US bond yields fell heavily on Friday. The S&P 500 closed down 2%. The Nasdaq fell 2.7%. The US 10-year Treasury yield fell 11 basis points to 4.25%. And the gold price jumped 1.2% to close at a fresh record high of $3,126.80 US an ounce. Number 2. ANZ's head of G3 Economics, Brian Martin, says markets have not fully priced in the potential economic, profit and value effects of tariffs into prices on the markets for shares, bonds and commodities.
We've had a move to neutrality. I don't think we've had a move aggressively short or certainly not long in markets. So I think they're just waiting to see what next steps to make. But I think optimism has, in terms of we're going to get supernormal returns from equities again this year, and that's all evaporated. And people are waiting to see where things go so that they can make informed decisions on what the implications of US tariff will be for real economic activity, for inflation, for employment, for government revenues, for fiscal policy. There's a huge amount to be considered.
Number 3. Inflation in Tokyo in March was stronger than expected at 2.4% from a year ago for the CPI measure that excludes food. That's up from 2.2% in February. ANZ senior international economist Tom Kenny says it's a useful leading indicator the Bank of Japan will be watching closely.
The acceleration in prices was broadly based beyond food items like rice and into general services. The Tokyo CPI is a decent precursor for the nationwide CPI. Thus, we should see a pickup in the nationwide CPI measure for March when it is released on 18th of April. In combination with encouraging news on wage increases linked to both union and non-union workers, these inflation data are likely to give Bank of Japan officials greater confidence about a virtuous cycle between wages growth and inflation. This in turn should reinforce expectations of further rate normalisations from the central bank as soon as the May meeting.
Number 4. Consumer confidence in New Zealand took another tumble in March, according to the ANZ Roy Morgan survey. ANZ New Zealand chief economist Sharon Zollner says it fell more than 4 points to 93, with normal levels being around 100.
So it's still pretty subdued, and it has actually fallen for a few months now, but in the bigger picture, if you look at it in a chart, it is still trending up, but it's making very hard work of it. And that's actually been the case ever since inflation took off in late 2021, and confidence just absolutely dived at that point, and it's been a bit of a slog since then.
Number 5. Sharon says consumers are going to be among the last to feel the benefits of an economic recovery started by 175 basis points of rate cuts by the Reserve Bank of New Zealand since the middle of last year.
The trend is upward, as you'd expect, given rates are going lower and house prices, while they're not going higher, they've at least stopped falling. But of course, we still have unemployment ticking higher. We think it doesn't have far to go, but that's not a good news story yet at the moment. House prices are expected to lift in the second half of the year, but there's nothing much to see there yet. You wouldn't expect consumers to be the first ones to feel the upswing. Now, they'll start to feel it once the labour market gets more robust, once the housing market starts to lift more.
Sharon Zollner there. Now, in today's bonus deep dive interview, I asked ANZ's head of G3 Economics, Brian Martin, about who might be the winners and losers in the tariffs Donald Trump is set to confirm, at least announce, on Wednesday night, and what might be in a tariffs review report due tomorrow night.
President Trump's view is that the winner is America. What you will see on the back of higher auto tariffs is a reshoring and an increase in the domestic US production of autos and light trucks. The losers, therefore, you would anticipate would be Europe, which is a big exporter of autos to the US, Japan, South Korea, Mexico, Canada, which is, very part of the integrated supply chain of cars in the US as well. So there could be a lot of collateral damage via supply chains and via direct exports from trading partners into the United States. So I think President Trump hopes that these types of severe announcements will have a material impact on changing trade relations with abroad, changing trade patterns, improving the US trade deficit. But it's not that simple. Because of the really integrated supply chains, because of product complexity, you can't just switch overnight. It takes time to reorient manufacturing. It takes time to build up the skill base, the productive potential to be able to produce what are really, high value added consumer goods at these stages of their evolution. I think what you could actually see is you could see some form of J-curve effect where actually things get a little bit worse before they get better. But as I say, it's all part of a much broader review. Let's wait and see.
Much broader review. What sort of things will it look at, and why is it important to understand that review?
Well, I think it's very important to understand it because when you look at the world today, the largest bilateral trading relationships are between the US and the EU, the US and China, and the EU and China. And it seems that China is very much in the eye of the storm. And President Trump has indicated that the European Union runs a very large trade surplus with the United States. He has said repeatedly that the EU does not treat America fairly. And given that there is such a large deficit there that the US runs, that's something he really wants to address. So will he look at the EU as a bloc? Will he look at individual countries within that? So very big exporters to the United States or Germany, Ireland, France as well as Italy, all in there. And could that lead to targeting specific countries in Europe? In which case, that's going to complicate Europe's response because Europe has a unified trade policy. It speaks with one voice. So it's going to be a really interesting thing. But we need to watch it and watch it very, very carefully because it's not just bilateral trade. There's a huge commercial relationship between the EU and the United States. US affiliate sales, that's US companies operating in the European Union, had sales in 2022 or 2023, but let's not argue too much about that date, of close to $4 trillion. So nearly 4 times the size of US exports to the EU. EU companies have sales in the US of about $3.3 trillion, 3 times the size of European exports to the EU. So concern is, will these affiliate sales, will these broader commercial relationships be affected by an escalating trade war? And potentially they could be. And then I think that is where quite critical concerns for economic activity could arise.
And how are consumers and investors reacting or treating this news, and what impact might that have on both the US economy and the rest of the world's economies?
The US consumer is not taking this well. US consumer confidence has fallen very sharply, whether you look at it from the Conference Board measure or the University of Michigan measure. It's off very significantly. And what's leading that decline is expectations. Consumers are really worried about tariffs. They're worried about inflation rising. And what the Conference Board is reporting is that when you look at the 6-month moving average, so let's not just look at volatility on a very short-term basis, the tariff impact is now beginning to show up in weaker plans for consumers to buy cars, for consumers to buy homes or move home. And that could have a material impact on the economy. My calculations are that about 20% of US private expenditure is discretionary. So as expectations come down, the risk is that consumers just tighten their belts so that marginal discretionary spend doesn't occur, and that weakens economic activity.
Brian Martin there. I'm Bernard Hickey. That was 5 and 5 with ANZ for Monday, March the 31st. Catch you tomorrow with a preview of the Reserve Bank of Australia's rates position. This podcast contains general information only, not investment advice. You should obtain advice for your personal circumstances before making any investment decisions. Please view the podcast disclaimer available via your media player or email.